Cautious spending, subdued wage growth and weakness in the labour market seem to be some of the main culprits behind the most recent weak sales report and an overall slowdown in the US economy. Joining me now to discuss the latest on the US recovery is senior economist Girard from RBS in Stamford. Michelle, we saw a similar decline in April, so what do you make of these retail sales figures?
Well, I certainly think that there's evidence that the consumer has pulled back a bit from very strong performance around the turn of the year. I think a couple of things are at work. Certainly the income picture is less positive. We've had slower job growth, and as a result, wage and salary growth has slowed. In addition, we actually have a very low savings rate. There were some revisions to data from late last year which suggested that, coming into the year, consumers were a little bit less favorably positioned to spend. The savings rate is low. It continued to move lower through April. It's at its lowest level that we've seen since 2007. So without, better income growth, you can see that consumers are sort of tapped out and are cutting back a bit on their spending pace.
The University of Michigan consumer confidence in May reached a high of 79.3, which was thought to be boosted by declining gas prices and a slightly more optimistic view regarding both current and future conditions. After looking at recent retail sales figures too, do you think this optimism will have faded somewhat in this month's reading?
Yeah, I think, and I guess that's the other part of the story that we sort of didn't get to when we were answering the last question, in the sense that not only are consumers maybe have less wherewithal to spend, given the uncertainty that we're now seeing about the U.S. economic outlook and the U.S. employment situation, as well as the Eurozone situation, it's understandable that there's a hesitancy, to be spending as sharply, and I do think that that is likely to come through also in the confidence reports. The Michigan numbers, as you said, last month were better, but most of the other confidence gauges actually declined in the month, and so I do expect that we'll see Michigan ease up a bit. The truth of the matter is in an uncertain environment like this, even the benefit of low gasoline prices may simply mean that consumers increase their savings rather than actually spending that windfall.
After reading your US Economic Weekly report, I understand at RBS you have now downgraded your growth outlook for the US economy in the second half of the year.
We have, given the fact that we've seen some deterioration in the employment situation, I do think that the magnitude of the slowdown has been exaggerated a bit by, some weather, some seasonal issues. But the truth is, I think there's also some suggestion and evidence that businesses are getting a little bit more uncertain and are beginning to move to the sidelines, if only temporarily. We've not only seen actually some softer softer employment numbers, but in terms of business spending and business investment, we've had some disappointing evidence on that front as well. So it's this idea that the caution on both the part of consumers and businesses may lead to somewhat slower growth in the second half of the year. So now, instead of an average growth pace of 2.5%, we're looking for growth closer to the 2% mark.
In regards to the prospect of this looming fiscal cliff, is your baseline forecast based on the assumption that all of the scheduled changes in taxes and government spending take effect at the beginning of 2013 or are extended?
I can't imagine that policymakers would allow the U.S. economy to go over the fiscal cliff, so to speak. And so our assumption is that the Bush tax cuts will get extended, and also that the automatic spending cuts will be pushed off. And we do expect that the payroll tax cut and the extended unemployment benefits will expire, and that those two programs shave about a 0.5 percentage point in our estimate off of growth next year. So we are looking for growth of around 2%. We'd be at 2.5% if, for example, those two programs were extended. But the outlook would be much, much worse if, for example, the Bush tax cuts were not extended, if the AMT indexation for inflation were not extended. In that scenario, we'd actually see growth marginally negative for the year.
Given your growth and inflation outlook, what are now the odds of the Federal Reserve announcing further monetary accommodation, and when?
In terms of the June meeting, we have to say that taking additional action in the form of balance sheet expansion, in our view, doesn't seem likely. The case can certainly be made, but in listening to Chairman Bernanke in his recent testimony, there doesn't seem to be an urgency at this point to engage in QE3. And our best guess is that they'd like to wait a little longer, particularly to see how the Eurozone situation plays out in the coming weeks before deciding whether or not QE3 is really going to be necessary. So in June, we think the odds of QE3 are low, but we think the Fed probably needs to do something. So we would say it's a close call about them extending their maturity extension program, or if they don't take actual action, we think they will send a strong signal with their language that they're monitoring the situation closely and are willing to act at any time if conditions warrant. So I think we will get something in one form or another out of this Fed at the June meeting, but it may not be outright balance sheet expansion at this time.
Michelle, thank you very much. Michelle Girard there on a downgraded growth outlook for the US economy and expected moves by the Federal Reserve. Now, we've got plenty in store for you today on Dukascopy TV, so do stay with us. But for the moment, goodbye.